Good evening, ladies and gentlemen. This is Clueless 8 Frank. It is 8:20 p.m. on a beautiful New York evening, January 31st, last day of this phenomenal month, 2016. This is an advanced group coaching session. And full disclosure, this is purely for financial education, and all opinion and forecasts are solely mine. This is not for any solicitation or advice. So let me do a quick roll call. We have Chris, a new member. Welcome. We have Craig Tuchek. We have Derek.
Yep.
My favorite Canadian. Aside from my brother-in-law. And we have Shawnee. Or we have Savvy. And we have Sienna. Good. So we have a great group. Thank you. Thank you for coming in. So let me start off like I normally do with a couple of observations. But prior to that, let me just mention a couple of administrative stuff, which I think are very important to you guys as well as to me. As we move forward into the year, and as we move forward into into February, it is extremely critical. And I know I sound like a broken record, that everyone glance at every single post that's tweeted on the real-time Twitter feed. As you all know, and Chris, you're new, so just reminding you, all the content that's coming from me, the trade alerts, the breaking news analysis, the Periscope broadcasts, all that stuff, the comments, the trader alerts that go out there, telling people to take it easy, sit back, fall over the chair, throw up, whatever it is. Everything is delivered on the Twitter feed. So it's very important that a window stay open on that side so that you get to see what is being posted, and you can always scroll back and see what has already been posted. So it's a storyline. Somebody's microphone needs to be muted because it's bouncing back. So if you don't mind, just mute it. Okay, thanks, Derek. I have such a lovely voice. I hate listening to myself. So basically, it is very important that that people, at least on the Twitter feed, get a chance to quickly look back and say, okay, he said that or he did that, whatever the case may be. In the chat room, which is, I think, also a very valuable component of my service, we talk about different opinions, things back and forth, and we kid around once in a while. And the bottom line is that's more informal. What we're going to start doing, and I'm going to be enforcing in a nice way going forward, because we have such great ideas coming from members too. Derek, for example, asked me to put up a chart on that stock that I did. So the bottom line is that let's keep that content coming from members, trade-specific content, I should say, in the trading room, or the trading chat room. Okay, so this way you can always click on that and see, okay, these are the things that somebody else is doing, and it's great. So we'll certainly let's try to stick to that, because this way the banter that we have in the regular public chat room about the markets and things like that, questions I'm answering, stay separated from the specific trades. Very simple. So that's it. So those are the main two chat rooms that we have. We have the public chat room, and then we have the trading room. The trading news brief, what's it called? Trading news, what do I call it? 1 second here. Let me try to get this. The trading news briefs chat room is, we have long, people get all this fantastic info that they put out there. So instead of congesting the public chat room and the trade-specific trading chat room, let's go ahead and put that in the trading news brief. So we can scroll on that, read on, hey, somebody posted, hey, what's going on with this and this company? Fantastic. So let's do that going forward. We just try to make it a little bit more organized, as you know. My service is in a process, is in a process of evolution. I'm certainly haven't reached that stage yet where I am completely happy with everything that the way things the content is being delivered, and I am certainly spending money on my from my side, as well as talking to the right people to do that. As you all know, that my previous developer moved on to do his own thing, and that was a little bit abrupt. But hey, that's the nature of the business. I'm talking about Siam Shogun, great guy, but he decided to move on, and so I am I'm talking to a few people to basically move on to version 2, trading, Clueless 8 trading 2.0 over the next few weeks, if not the next month or so. So just keep that in mind. So those things are very important. Now, coming to charts. What these sessions that I do are critical because I go over in minute detail, as you all know, not just on the forecast, but how I'm putting together these extremely precise charts. Uh, Let me just remind everyone, forecasting is extremely difficult business, and how the heck I do it, I have no clue. Okay, well, I certainly have a clue. I'm just saying it, but when you think about it, these forecasts, even these big shots sitting there taking home 10 million, sitting at Goldman Sachs, can figure out where the market's going to go over the next week, over the next 2 weeks, or even the next couple of days. And yet I'm hitting out of the ballpark with some home runs on where the markets would land up within a certain time frame. It's extremely difficult stuff, but I have repeatedly shown, based on my methodology of pattern symmetry and all the other stuff that I talk about, that there is a method to the madness. In the old days, I used to say, if you focus, it is the market, there is a method to the madness. If you focus on the madness, you're going to be done. You're finished. And many have. We have had traders who have come in, just mentally just lost it, moved on, whatever the case. They don't trade. A bunch of them were friends of mine, and what can I do? The bottom line is, but if you focus on the method, I can assure you, at least from personal experience, that there is significant amounts of money to be made in the market. I've been doing it for years. I've been in the doghouse. I know it. Time to time, on certain positions, I get in the doghouse, but I still seem to, do well. Now, saying all that, trade management and flexibility, those things are something that you will have to learn on your own, to be honest with you. And but at the same time, I give some helpful pointers on what can be done, and I'll talk about it tonight too. So that's basically the administrative stuff. Very, very important as we go forward. This market is going to get extremely difficult. It has already been difficult. We know that. And the easy days only come after after some extremely painful decisions that traders have to make, and alert, and suggestions that I put out there on days that no one wants to even look at the market, and we all know that. We all know that, and then the rewards only come when you are positioned right on very ugly days, whether it be on the long side or the short side. Let's say on the long side, you position yourself on very ugly days, and then you reap the rewards, when things work out and move on to that direction. But saying all that, the key thing is, which is I think the most critical aspect about this business, falls into that behavioral game theory aspect of the business, is never get complacent. Never get complacent. When you think things are, this market's on a run, it's going to get up there, it's going to be another, 600-700 points, we're going to get up to 17,000, stuff like that, right there they whack you. Now, technicals and charting and the type of strategic charting that I do certainly put things in perspective. There's no question about that. And anyone who spends time looking at it, understanding it, even this chart that you're seeing behind you, which is worth hundreds of thousands of dollars for larger traders, millions of dollars for hedge funds, and thousands of dollars for individual traders. They have to be taken, advantage of. There's no question about it. Like, I don't kid around when I say there are no perfect moments. You have to take the moment that's in hand, and you gotta make the best out of it. These three bars itself are worth about 700% on your money if you were playing, or at least 4 to 500% on your money. Just these three bars alone, okay? If you were playing the S&P calls or the SPY calls, and that's all validated. I screenshot a significant number of the option plays, and I'm going to try to put by tonight, hopefully, I'm going to try to put a whole bunch of them in a separate post that people can see it. When $8 calls, the S&P 1900s expiring on January 5th, which was Friday, go from 8 to, if I saw correctly at the end, to 40 to 38. Nobody has a right to complain about anything. $800 is $3,500. $8,000 is $35,000. Anybody who put $80,000 on those calls did their head checked. But you know what? That $80,000 would be $350,000. And that's a game changer. And at some point, somebody should do it. If they have the ability, do it. But that's it. That's your trade for the first 6 months of the year. You sit there and you go out there, you have a drink, you tell your buddies, you know what, I'm with this Clueless A trading service. This guy showed that we're going to go to 1930, 1940 on the S&P. The frigging thing went there and my calls went up. I put a stash of money. I didn't want to look at it. I was nuts, and look where I am right now. And this has happened repeatedly, by the way. From a trade management standpoint, I personally wouldn't put $80,000 on a S&P thing. But you know what? It's just numbers. Whether you put 800, it depends on somebody's ability to do it, obviously. But whether you put 800 or whether you put 8,000 or 80,000, it's just a couple of zeros next to it. I know it sounds frivolous, but it's true. The percentage returns are the same. So what I'm getting at is if you want consistency, then you do moderate amounts. Because if for some reason, this particular thing, which we're going to dive in the next couple of minutes, which was looking like a bear flag till it broke out. And I talked about that extensively. Is it a bear flag? This bear flag, certainly looked like a bear flag when we had these candles. And at 12 noon on Thursday, it looked like it was going to break below the 1874 level. In that case, you would have a bear flag. And you get blasted out if you're long. But I did say that there was going to be some monster window dressing, because these fund managers who were not buying down here, this was short covering. That's a short covering candle. Hardcore. The shorts always cover first. We covered around these levels too on the S&P puts that we had. So they covered there, and then the bozos came in and bought at these levels. Remember, the market is a manipulated beast. Prices came down to levels where these fund managers said, you know what, we are going to buy the market. And that's exactly what they did. Because they want to show that. They want to show strong stocks in their books. And it's basically a portfolio markups. It's highly illegal if you really think about it. You just buy these stocks at the end of the month in the last couple of days, just to show that you have them in the books, so that when your reports go out, your monthly reports go out, they say, oh yeah, you did own Facebook, or you did own Google. Like, oh, okay, you're a smart guy. So it's all pretty rigged if you look at it that way. Do they know that the market's going to fall like that? Maybe some of them do. Some of them probably don't, because there are way too many global players in the market to determine what the markets are going to do on a daily basis. In the old days, we control the market, means the US. Whatever we did ruled. Nowadays, it's not the same. There are global players out there from Dubai to Hong Kong, big institutional hedge funds sitting out of Europe who are trading the market like it's nobody's business. And so even though we still manage the largest trillions and trillions of dollars worth of monies in equity markets, global equity markets. We do not have full control of the markets as we used to. So that's really what it all comes down to. So let's get into nitty-gritty of looking at what might happen, and then we'll talk about a few stocks. Keep in mind, we're still in the heart of the earnings season. There's a lot of them coming out. We're going to play them. We've been very successful overall, playing a whole bunch of them. One very important pointer when I talk about the ER plays is that I go through the list and then I pick and choose the ones I like. So right there is value-added service, because honestly speaking, if I showed you a list of 40 companies reporting after hours on Thursday, let's say, I can assure you, you would have no clue which ones are the other than the marquee names. But then everybody's looking at the marquee names. But who's looking at Citrix up 6? Who's looking at a whole bunch of other, some of the names are not coming to my head, and so I make a point of looking at them because I know a lot of these companies. I've been in the business for a while, and I mean, I was in the business for a while, and I kind of know some of these companies and how they behave. Then I look at the charts. Then I add my gut feelings on what I think might happen, depending on the charts, depending on what I know about the companies, and then I put it out there. And a lot of them really, fantastic. $3-4, not just 20, 30, all that stuff. So it's there. So we have a lot more to play coming up. So what's the best way to do it? In my opinion, what I've been doing, not that anyone has to follow it, I've been trading the common mostly because the premiums are so stuffed. Somebody mentioned to me, you know what? I had a whole bunch of these 550 puts on Amazon. They expired almost at zero. I said, yeah, obviously, because Amazon didn't go to 500. It actually went to 546. So what do you think? You're going to make money on that? You think the option makers, the market makers, are that stupid to give you money on something that hasn't even reached your strike? They said, well, the stock was down $87. I said, so what? The premiums were stuffed. I've been there before. That's why I talk from experience. I'm not here to just mouth off things that I haven't personally experienced myself, which most other services do, to be honest with you. Chris here came from a different service, and the guy used to show all this stuff, and I'm not saying anything bad. There's smart people out there, but he never showed the methodology and stuff of why he was doing things, what they were doing. And I open up the book, and there's a lot of stuff that on the background that I do that over time and experience, you guys will get it. Practice makes perfect. You can't learn all this in one day, but you're getting an accelerated learning process because I'm spending the time and the energy for a very small amount of a fee to explain to people that it's not. Hey, Jim, can you hear us? Fish Eyes just.
Hi, Frank. Just checking in late. Sorry.
No problem. You can always hear the first part. It'll be recorded. I'll upload it tonight. So,
Cool.
So basically, as I was saying, like a lot of the other services, like there's some hidden magic. What's going on? Yeah, there's no hidden frigging magic. It's structured volatility. But they make it sound so that just like any other slick salesman, it's like, okay, I know what's going on. You don't, so I'm not going to really tell you what I'm looking at on the charts and stuff. Remember, every single one of my recommendations, suggestions, I should say, come with a visual picture in real time. It takes a lot of work. It takes a lot of work to do it in real time, put it out there, put the trade alerts out there. It's not that easy, especially in very volatile markets, which happen which happen at least once or twice a week, as we all know. So keep that in mind, and that's why I'm very direct sometimes and cut people off, because they have to realize that I cannot be operating like a robot. It's not physically possible. God has only given me a couple of fingers to type on the keyboard. So anyway, you're looking at the Dow Jones Industrial Average here in the back. So let's get straight into the charts here. So this chart itself speaks volumes on what's going on. Volumes. And anybody with a little focus here will understand what's going on. I talk about pattern symmetry a lot because there is pattern symmetry. There is pattern symmetry. There is a pattern symmetry because human behavior is manifested in patterns on charts. These things are not just happening because there is some weird, machine that's doing it. It's human behavior manifested through algo high frequency trading programs, which manipulate and force humans to do certain things, mostly wrong things at the wrong times, as we know, and all that kind of stuff. But it's humans who are basically eventually in charge of the decisions, and of course the machines take over and do what they need to do. So saying all that, look at this chart very carefully. It goes back all the way to 2012, June of 2012, a clean chart. Here's the uptrend line. Remember, a chart, if I left this chart and did this, for example, okay, on this thing, can I hide drawings? I guess not. Let me see. I don't want to delete all the drawings because these are precious. Okay, let's just imagine you just were looking at this chart. It wouldn't make a lot of sense to you because the simple eye of a simple non-trader, technical trader, and even professional technical traders say, oh, it's over. I mean, look at this huge thing. This is a huge head and shoulders. It's over. Well, in between that over, the markets have delivered 2,000% type of returns on or more on tradable instruments that we trade. Here, and we'll see what happens here. We'll talk about it. So my biggest contribution is, and all of you have to understand this clearly, is all the other drawings that I transpose and juxtapose on top of this, of the basic chart, which is basically the candle chart, to make sense of what's going on, and not just to make sense. We're not in the business of, I actually don't like that word that I use. It's not about making sense. It's about making money of these lines, of these patterns. But I put it out there, and the more you see it, the more you train your eyes. That's what it's all about, training your eyes and using part of your mental abilities with all the suggestions and the teaching and the stuff that I teach, and then you see the whole picture. So all the stuff that I put out there, all these lines and stuff, everything has a meaning. Everything has a deliberate impact on my bottom line profits or losses, period. So you want it that way too. So you gotta study the charts. Now, studying the charts doesn't mean you're gonna understand it. It's gonna take a while. But the more you force yourself to do it, the more you will benefit and the better off you'll do making monies in the market. And it doesn't matter what type of market, because honestly, I have no idea if we're going to go back and resume the bull trend, or whether we're going to come down and be in a bear market for the next year. I have my opinions, but as in certain ideas, no. But I don't care. And the reason I don't care is because I'm making a shitload of money, excuse my French, trading these markets, and I feel great. Because a couple of years ago, I'd be shit scared like you guys. Well, some of you guys. Like, what the hell's going on, man? Oh my God, Now, give it to me. Give me a 500-point down open, and let me show you how you can take home a stash of cash. Seriously. I've shown it repeatedly. So that's what I'm talking about. All right. So let's start off with the Dow Jones Industrial Average, okay? Mom and pop's view of the market. So here we have these lines are specific. You have the flash crash. You have and remember, the Dow Jones and S&P are slightly different levels. Not all of them. You know, the Dow Jones didn't come down and it almost came down and tested the lows, while the S&P at one point didn't. So they all have to be somewhat together. So this is a very powerful line, support line, you can see here, which is around 15,800, right there. Okay, right there, 15,800 or so. And if you notice, okay, this was the retest, a higher low retest, of course, September 29th of 2015. Seems like such a long time ago, guys, doesn't it? It's like, wow. Remember, from a mental standpoint, because of the preponderance and the huge movements that volatility movements that the market is incurring and will incur more going forward, thanks to the machines, every passing week will seem like very far away. I'm not kidding you. Think for a minute. Because the movements are so big, up and down, that your memory capacity will diminish. In other words, you won't remember what happened 3 weeks ago. Believe me when I tell you. Because I could ask a couple of quick questions as to if anyone really remembers specifics of lows if I don't show you the chart, and I can assure you that we would have a lot of disparate wrong answers. So that's volatility. The essence of volatility is to shake traders up, investors up to a point where they lose their memory. That's a behavioral aspect of this business. Remember that. But I remind myself of that memory every single day and every single evening by looking at the charts. That's a critical component of forecasting. Let's move on. So we have September 29. We have the recent lows here, which was January, which tested that infamous, well, we'll look at S&P 500 in a second. Tested the 15,000, what was it, the 15,500 level or so, slightly below that. The big hammer reversal that we encountered. I'm going to zoom in a second so you guys can see it. And the retest of this line, which I had drawn. Now, why did I draw this line? You guys can do it yourself. You got one here. I did a second touch here. And bingo, I left it alone. And guess what the market did? The market came exactly, punctured the line for about an hour or two, or if not, what hour or two, probably for 15 minutes, and then bounced hard. So let's zoom in. And this is going back to 2012, okay? I don't know who else did this chart, but I did. You know, if somebody else did it, I'd like to make friends with them. Seriously. I'd like to meet more traders who think outside the box, to be honest with you. So if you know anybody who actually does this type of forecasting and has been this accurate, not just on the low downside, there's a lot of bearish traders, mind you. I'm talking about the difficult aspect of a bounce after, when everything just looks lost. So let me know. So here we are, zooming in, right? So we have these huge moves. So here we went as low as 15,400, bounced hard, and look what we did the following days. Let's remind ourselves. Monday the 25th, we have a reversal tail right off this channel. This channel wasn't drawn by a machine. It was drawn by me. I'm talking about these channels. I started drawing channels a couple of years ago because I never saw anybody else doing it like this. And guess what? They actually worked. So I said, that's it. I'm going to follow my own BS. And I started doing this. It's not like you can do it on every chart, by the way. Okay? On the indices, it works best. So if you notice, this was the channel drawn. Now, why did I draw this channel? Just, off the blue. I drawn this way before the market, basically fell apart, because it was supposed to be like this. The top here, reversal top, supply point, 18th of September, 2014. And then I tried to touch it's not perfect. The lows here, which was mid-December, when all you could hear in the media, all you could feel around us was, oh my God, Santa's dead. He's not coming back. It's over. Then Santa came back with a vengeance, with a couple of bazookas, and took out the Grizzlies. And we had a massive, massive rally that started on the 17th of December. Big one. This was a big rally, which ended at the end of the year. And then you had this big volatility cluster. So I drew the channel based on, you try to touch as many points as possible, and you'll see how fantastically it works. Now look how the nuances of reading a chart. Look, anybody can read a chart, but who really understands it? Ask yourself that. Who really sees the finer points? It's like art appreciation, I guess. Guys who really understand the great masters, okay? They look at the painting and they can look at certain things. It's just unfreaking believable to point out certain things. Chart reading is exactly the same. And the more you focus on that, the more your brain trains itself. The brain is nothing but a muscle. Train it to be smarter. Train it to pinpoint levels that you haven't seen before. And all I do is try to help out on that aspect. So when I've drawn this channel here, look what it did. The market hit it exactly once, twice, bounced down. Now, what kept me in the game? If you listen to my previous video cast, you got to link it all together, because I'm telling a story and I'm making crap loads of money telling this story because I am sticking to the discipline. What happens in the middle of the day in our rooms, and nothing wrong with that, when you hear like, oh my God, okay, we're in a, some people just come up with the most insane, stupid statement, but that's okay, because they're trained to think stupidity by the media, by their people that they were hanging around with, the trading clubs they were in, the simplistic view of a non-machine market. This is a machine-driven market, so you got to think of it like a robot. So what kept me in the game? It's very simple. I kept on talking about it. I said, listen, keep on looking. This is like as good as a daily chart, right? Keep on looking at the underlying stochastics. How difficult is that to do? Who gives a flying F if the market is down 300 in the middle of the day when you have some cash on the side and on a swing trade you're going to make money? I did. I wasn't even around on Friday afternoon. It was printing money on my S&P calls, which I sold off my frigging iPhone. Sitting there. So, but because that was my reward for being disciplined. And I had sold. It's not like I held the whole thing, selling bits and pieces off. This was it. The simple stochastics. And I kept on talking about it, if you all remember, for days and days. And my video cast, please go revisit it from last Sunday and the one in the middle of the week, I believe it was Wednesday. I said nothing changed. Jim knows very well. We were doing one-to-one sessions with Jim and two other people. Fish eyes. I said we were going to go to 1930 to 1950. And Fish Eyes knows. He's been with me for a while, and he's reading the same thing. So it's hard. It's hard to hold when you're looking at this stuff. You're like, shit, man. I'm looking at this stuff, but it's not. Look at the market. It's pressuring me in the middle of the day. Who cares? That's what the machines want. They want you out of the game. They want you out of the game. And then they'll do what they need to do overnight and during the day. So saying all that, the simplest way of looking at this daily chart of the market, Dow Jones, for example, is look what's going on underneath. I talked extensively about the Kopach curve, remember? And if you guys haven't seen the video cast, some of you guys haven't seen the video cast, then I don't have anything to say but to say shame on you. Because anybody who really listened to my video cast and looked at the visuals that I was pointing out made a crap load of money on the index calls for the week. No question about it. I'm not going to walk away from that. Because the Kopach, which I can add here in a second, I explained this clearly in the video cast and I'm explaining it again. So this time, act on it. This is slightly beyond daily, so it gives you a bigger time frame. When you get down to these levels of the Kopach curve, what do you think the markets are going to do? They're going to have a frigging hardcore bounce. The Kopach never stays down at minus 15. Look at that. It actually, hit lows after the flash crash. Can it linger around a little bit at these levels? Absolutely. But if you want to swing some stuff, specifically on the indices, then you can pretty much bet on it that you are going to have a bounce going into March. And this is telling you that because you don't get this oversold. Stochastics are more faster moving. The Kopach, and please feel free to look at the actual definition of that on Investopedia. Mr. Kopach, it's more of a swing trading thing, more of a medium-term idea of what's going on. Now, unless something is fundamentally, completely broken in the world financial system, which, by the way, the credit markets, the junk bond markets are actually healing after taking a massive beating. So unless something is completely broken, which, by the way, just so you wake all of you up, the system never changes. Just the way the political power in Washington never changes. It doesn't matter who's on power. Like, remember that, I guess there's this old movie says Mr. Smith goes to Washington or something, right? You can't change the system. It's built in. You can work around it. You can't change it. So that's the same thing with the markets. The world financial system cannot be changed, period, whether you like it or not like it. We're not going into a Great Depression. Are we going to have big fallouts and we have tactical pullbacks? Absolutely. But anybody who's sitting there, the doom and gloom that the world financial system is completely broken and stuff. Look, the only time the world financial system lost control, not broken, but lost control was 2008, 2009. I was there. That's when they lost control for a bit. So just remember that, guys, okay? So when you listen to all these hardcore bears, because there are no hardcore bulls left, by the way, right? You don't hear them. So the hardcore bears telling you that this is the beginning of the end, tell them to take a nice hike. Because all we're doing is trading ranges. Remember that we're trading ranges here. So Kopach is telling you, coming back to it, that on a swing basis, this market's going higher. If it was up here, Kopach will peak, and you do not, I don't care, you do not want to be heavy long. You want to be selling a good portion of your monies when you get up to these extreme overbought level, which is around plus 15. So another new thing you learn. Try it. Put it on your charts. You can see that. Now, don't expect this to be a monkey on a hot tin roof, right? They're not going to jump around. It's a more of a slow swing move. It's a bit like that swing 533 charts that I use. So saying all that, on a daily basis, this is looking good. It does not mean that we're not going to have a turnaround down here this way, which means that, let's say, for example, this goes up here and then decides to take another dive and create a double bottom here on the stochastics. What do you think is happening to the market? The market will do this. We could come back and retest. Again, we could fall another 600 points, retest, and make a move here. So all that is in the cards. So at this point in time, the key thing that I talked about, the second critical aspect that I talked about on my video cast, very critical, because that's money in pocket. That's one thing I learned about trading, by the way. You can show the most brilliant forecast and tell people, okay, this is the way it's looking, this is the way, it's an 80% probability or more that it's going to get there. You can't make them do what they don't want to do. Look, our brains are wired to not make money. I don't know if you guys know that. Since kids, we're always hearing the word no. Think about it. Behavioral aspects is what makes people crap loads of money in the stock market. Okay? Your brains are wired to scare you out of positions and make the stupidest decisions. It's happened to me. Even the fact that I constantly train myself not to be. So one of the other things that I talked about extensively is the simple mathematical standard deviation. The standard deviation from here to here. Let me get all these lines out and draw this new. So the standard deviation from the moving averages, the 34 and the 50, okay, right here, was huge, was equal to this, which was like a -9. Standard deviation. You don't know what a standard deviation is? Somebody doesn't know? Please, just Google it. I'm not going to teach basic math here. So the bottom line is there's a reversion to the mean. It is going to happen. There is always reversion to the mean. Now, here's the trick, and please listen carefully. Reversion to the mean simply means it's going to come and try to get close to this 50 and the 34-day lines. Now, what if the 50 and the 34-day lines start to crash down? Then the reversion to the mean doesn't mean it's going to get up here. It simply means it can maybe get up here. So in a bear market or an intermediate bear market, just so you all know, and we might be in one of them, mind you, the downward sloping moving averages, act as major resistances, obviously, because then once you kiss it, all of a sudden, you're back to the reversion to the mean is complete, right? The only time where where you're going to have a large scale move higher, and none of those pundits out there or a lot of the idiots that you listen to in the other forums will ever tell you that, is that the only time the one way where you can stick to a trade and make a fortune is when you see the moving averages either flattening out. Let me draw it clearly for you guys. This is serious stuff, okay? So take it seriously. When the moving averages, if they, let's say, for example, flatten out here, that's telling you something good. If they keep on falling, then that means that we are going to sell every major rally. Simple. In a bear market, you sell rallies. In an intermediate bull market, you buy dips, sell some in rallies, and still rally. But that is a function of what the moving averages are doing, because the moving averages are nothing but an aggregate of prices, right? 34, prices over 34 days averaged out, prices over 50 days averaged out. So what I'm watching very carefully is the shape and trajectory of these two lines. If these moving averages keep on falling, then that is clearly indicating that, yes, we'll get retracement bounces up to the 16,000, possibly 17,000 level, or at least to the upper end of this channel here, 16,800, let's say. So you're talking about another 300 points or so, right? On the Dow Jones, on the overall market, that it's going to fail. And a failure means back down again, test this support level here, 16,400, possibly bounce over that, touch the downward sloping moving averages again, or this downtrend line, fail here. In other words, it's going to keep on doing this down to a level where things get really cheap. We don't know that yet. So the way we'll know, and you can do this yourself. That's how you train your mind. Okay, you don't have to rely on me. Is you need to basically look at the shape of these moving averages. Let's look at the daily, which is very close to the 2-day. So on the daily, you can clearly see that the moving averages are. See the difference? Look, if I move out a little bit more on the 2-day, the moving averages actually look kind of flattish, doesn't it? Yes?
Yes.
Yes. Okay. Now let's zoom in, because every time frame will tell you a different story. Now, why these things I take so much time to explain? Because the key, remember, not getting into a trade means nothing. It's where you get out. Yes or no, guys? And Shani?
Correct.
It's where you get out. Because what do we do most of the times? Or what do you guys do most of the times? I mean, I do too sometimes because of the volatility. We leave the trade early. And we say, oh, you made some money. So what? Does it feel great to make, let's say, $2,000 on a trade where you could have made 15? And do I need to remind all of you how many times you've done that? Including Friday? The famous excuse we like to give ourselves is, we made some money, so what's the big deal? Well, there's a frigging big deal. Because the extra $13,000 that you left on the table could have changed your mental framework. That's the big difference. So that's the reason why I explain these things in a very objective, technical manner, because if you can stay with that trade, I'm not saying the whole lot, sell a little bit along the way. Let's say the SPYs, let's say somebody says, oh, well, I don't have money to buy these SPX calls, they're $8, $13. Okay, understood. So let's say the SPYs, put a bunch of them, let go of 1, 2, 3, 4, 5, I don't know. So it's not the entry point, it's where you get out. And if you don't get it by now, my famous last word, slap yourself silly to the point where you fall. Because this is getting ridiculous, guys. You know it. How many times are you going? Because I read people. How many times are you going to keep on missing trades? Specifically on the indices, on the markets. At one point, you got to say enough is enough. I am sick and tired of myself. I've said that to myself. I am sick and tired of myself. And I am going to make a crap load of money, not just good money. Look, there have been cases where I have let go of trades and it could have been 6 figures in 2 days. In 1 day, 2 days. And I still made decent money. You know how I felt? Like a wet rag. Because this is a competitive sport. This is not something you do for just fun. This changes your lifestyle. You put some money away for good things, for your family, pay off the debts, do all the stuff that we need to do. We're working people, right? We're all working people. We're not sitting here on trust funds. This is our trust fund. So manage it right. That's the reason why I focus on these things. And for God's sakes, you guys got to get serious. Some of you more than others. It's not going to be easy. Nobody says it's going to be easy. But how many times, I repeat again, are you going to let go of trades when the forecasting has been so dead right and you don't even have one call left, which goes from 5 to 60? And you know we've done that a few times. So I don't, you know what I'm getting at. So when you look at the beyond the daily, they actually look flattish, to be honest with you. This is fine. Kopach looked fine. So let's look at it a slight different time frame. So the time frame that we're looking at is daily. Okay. On the daily, you can see, and I'm going to show this to you. I was looking at the Thinkorswim. I was doing some homework before I started the session. We're getting pretty goddamn overbought. You know what that means? We're going to get a nice hammering of 300 to 400 points this week. This week, we're going to get it. But there's an alternative scenario if things are, market wants to power higher. Because remember, part of the market, a good portion of the market, when it wants to go up or down, has nothing to do with economics. The market knows very well that the central banks, including Japan, which went ballistic and brought down their rates to negative. Yeah, somebody said, oh, it's a terrible thing. I said, what the hell do I know? So what the hell do I know? They did what they needed to do. That's big guns. Bringing down the Japanese central bank rates to negative. Some shorts. There were a couple of jumpers that day. I'm telling you, some hardcore grizzlies. I saw jumpers back on my days on Wall Street. It's a terrible thing. Guys actually jump off windows. My first day when I started, I'm not kidding you, it's terrible when I think about it. There's a guy who jumped Trinity Church, which was the oldest church in one of the oldest churches in the nation, right there on the head of Wall Street. There's a guy who jumped off one of the buildings and fell in the tombstones. So what I'm getting at, there were a lot of jumpers on Friday because the Japanese government took a bazooka to the hardcore shorts and the world markets reacted. I couldn't believe we were up 400 points because I was, dealing with my son. He passed the driving test, kick ass, like all kinds of good stuff. So I was like, what? It went beyond what I thought the market was. I was saying, what, 1920, right? Savvy? I was saying 1920, this and that. It just took out the stops. Just the way it took out the stops on the downside here, the market is at this point hell-bent on taking out the stops on the move up this way. So at this point, if you want to look at it very simplistically, we are going to engage the 34-day moving average, looks like, after, a minor pullback, and that's around 16,800. Also, that's the downtrend channel that you're looking at. Very clear. Right here. This line and this line, this red line. So 16,800. Overshoot means 17,000, right? What does 17,000 match with? It matches with engaging the 50-day moving average, which is 17,100. Do I think we're going to blast through the 50-day moving average? Absolutely not. I don't think so. But you know something? I'm probably going to be wrong. Because every time I say absolutely not, I'm wrong. Because that's when I'm getting dogmatic. What the hell do I know? All I know is that we have a very sharp look at the pattern. I already saw what's going to happen. This is called the crystal ball, right? People keep on saying crystal ball. It's right there. We just have to open up the ball. Look at these lines here. Please, let me get the marker. And you're going to see it. Look at these Bollinger Bands, like dropping like nobody's business, right? Look at this Bollinger Band. Does it look exactly the same? Give me a yes or no.
Yes.
It's like definitively yes. That's a given. Did these Bollinger Bands not fall, keep on falling like it did through the rally here and through the rally here? Yes?
Correct.
Correct.
Yes.
Exactly. So when you have to extrapolate out, does it not look like the Bollinger Bands are going to come and do this? Correct?
Yes.
So what do you think is going to happen? I'll tell you what's going to happen, at least by looking at it. I mean, is Mr. Pester. Jeremy, did you walk in? Jeremy. Okay. Yes. Okay. You can listen to the first part of it. I'm going to upload this one because I think everyone should listen to this. So it's going to fall, and then we're going to engage. So where do you think we're going to engage? Exactly the same levels that I said we're going to engage, which is around 16,800, maximum 17,000. What do you think happens after that if we follow pattern symmetry? Nice fat pullback. Correct?
Yes.
Crap loads of money on that pullback. Right there. Is the pullback going to be, let's say we follow, I personally think, this is weird, but I'm going to say it. I think we're going to follow exactly this trajectory. So if that's the case, we have a little bit more to go, a couple of 100 points more, which is still a decent sum of money. Everyone gets all excited, like, oh, wow, market's all good. No, it's not. Market's never good or bad. It's just the market. How about that? So, and then we fall. Now, if we follow this pattern symmetry, then the retest of 16,000 comes back into play. So if we fall from 17,000 to 16,000, that's another 1,000 point drop, similar to what we saw here, right? That 1,000 point drop, if you do it in S&P terms, is roughly about 160 S&P points. And once we fall there and everyone just basically gives up. Now remember, if we don't hold these levels, then of course we're looking at down here again. And trust me, that can happen. But if we hold here, that starts off a double. Remember, this is a double bottom. So let's say we create another double bottom after we rally into, let's say we rally into February, or at least, some part of February. And then depending on how fast we go, that I can tell you. And then we pull back. And then if we follow this pattern symmetry, we could basically move higher and engage this big fat downtrend line, which is around 17,700. All this you guys can read on your own because I post these charts. What I'm showing you is the possibility of what can happen. Now, if somebody says, you know what, things don't always work like that. Well, yes, things don't always work like that, but they seem to work often than not the same way. So I'll go by my charts rather than what somebody sitting out there having a beer is prognosticating about the market. So that's what I think is going to happen. I think we're going to engage the 34. We're going to get pretty severely overbought, which I'm going to show you on Thinkorswim. We are pretty overbought right now. Doesn't mean we're just going to have a pullback, a real pullback. What I'm going to watch carefully, just so that off the lesson on this particular chart, is I'm going to keep on looking at the trajectory of the downward sloping 50 and 34-day moving averages. Remember, markets can keep rallying. Markets, no problem, Jeremy, without the mic. As long as you can hear me, that's fine. But make sure you have it. So markets can rally. Okay, start to rally. Markets can rally while the lines are falling. Remember this. Look at this carefully, please. Train your eyes to look at this. Hold on 1 second. Okay, look at these lines. Let me get this line out. Okay, very clean. So look at these lines, 34.50. They're falling hard. They're falling hard. And you had a rally from 15,954, let's call it 16,000, all the way to 17,202. That's 1,200 points higher. And why did I pick that point? Can somebody tell me? Seriously, because somebody tell me. Guys, man.
It's a resistance.
No. What were we talking about here, Shawnee? What lines are we talking about? What I'm saying, huh? What was, what?
Never mind, I'm backing away from this. I'm sorry.
No. What have I been talking about for the last 10 minutes regarding what lines I'm going to be watching?
The 50 and 34
Thank you.
averages.
Thank you. Guys, if this was my son's high school, you guys would be D-grade students. I'm dead serious. His high school, by the way, is rated 42nd in the US. Tough ass. You guys, come on, wake up. I'm talking about the moving averages for the last 15 minutes. I feel like I just wasted my time.
No, that's what I said. You were talking about the moving averages.
Okay, so why did I pick this point here? Okay, so I give you that. You said about why did I pick this point here? Just look below. Can somebody else chime in?
Could it be the 50 and 34 cross?
Thank you. The 50 and the 34 cross. Once you get the 50 and the 34 cross, ladies and gentlemen, it is complete mayhem for the shorts. And from a technical perspective, you hear the idiots come on TV and say, oh, now it's a crossover, this and that, we're back in front. But here's the trick. By the time the lines cross, 50% or so of or more of the rally is already done. That's what I was getting at. You get it?
Oh, yeah.
That's where my value-added service comes in, because I've already made my crap loads of money off the bat. Let them go for the 50, because by the time the lines cross and keep on crossing higher, right, like it did here, and I've gone through this stuff before, by the way, so please focus. Some of you have been with me for a while. You got to know this like the back of your hand. The crossover of the 50 and the 34 is a very powerful trigger, but it only leaves you with maybe 50% of the move still there. So you can still stick with the trade, but the key thing to watch was this, that the stochastic crossover is far more important than a moving average crossover. Do you guys understand what I'm saying?
Yes.
Exactly.
Yes.
So when they talk about moving average crossover and stuff, yeah, in the old days it worked like that. Not anymore. This crossover and overbought, oversold conditions is exactly which makes you the big money. Remember my words? The 24 to 48 hours when you make the easy money off the ugliest levels? That's pretty much it. So what I'm getting at is that it took that much time for this crossover to happen. And there are very traditional gurus who sit there like, oh, I'm going to buy the crossover. Well, let them go to hell. I really don't care. Because I'm tired of like old guys with frizzy hair telling me how to read the charts. I'm here to make money. I'm here to make money fast. So what I'm getting at is the point that I want to impress is that you got to look at the Bollingers. You got to look at the stochastics. It's giving you a sign that things are ready to go. Just the way it gave us a sign, things were ready to go. And I told you all it was ready to go. And now we're starting to get towards the overbought level. These lines, by the time they turn around and cross over, most of the gains are done. I'm telling you right now. Okay? Just the way it happened here. And it's happened every single time. It's the same way. So yes, you will still get some nice gains. However, the crossover can stay intact, as you can see here. But look what happens. You get big fat sell-offs. crossover still stays intact. Because the stochastics are severely overbought. It's really simple chart reading. And of course, you have to look at the Bollingers. So by the time the rest of the world starts to get really excited about the market, you start selling. It doesn't mean you start shorting really hard, because the point is that if the lines and stuff are moving up, you are going to get bounces, big bounces. So that's one way to look at it, okay? The other thing to keep in mind, and I'm going to pull in the Thinkorswim chart right here because I noticed it earlier today. Why the 34 DMA? Because it works for me, Chris. Seriously. I use the 34 and the 50 DMA like a frigging precision guided JDAM. It works for me. Don't know why. 50 everybody looks at, 34. You can use any lines you want. So, you know, it's just worked for me over the years, and it's pretty happy with it. So that's so Shawnee, you had the right thing, but like I said, you know, just you were not answering it correctly. I picked that point here because that was the crossover point. So even though it looks fantastically bullish on the charts, there was only a bit of, I would say, 40 to 50% of the move left, which is still damn good, to be honest with you. But this is where the money really was made. And if you bought a little bit here, you could have traded all the way up here and let go of things, and whatever the case. So this is what I saw today. So bear with me one second. Let me look at the. So let me show you the S&P 500 while I'm at it on this chart here. I called this. Okay, I said possibly a bear flag and then the breakout. Now, of course, I mix and match with this, with the quad HFT charts, high frequency trading charts, and all that stuff. And, you know, those were showing me certain things. On the quad, which I can't pull up on this CPU, the Bollingers got stretched out to the top. It was like, whoa. You know, I wish I was, you know, sounds more important than sitting in front of my machine. So, but seriously, the way things went after 3 o'clock, after 2 o'clock, they stretched the Bollingers out. And Savvy and you guys, some of you guys who are tracking the Algo HFT quad charts, you saw that too, right? You can literally take the Bollinger and stretch them out. You don't need to be, it doesn't act as resistant anymore. It's like time to go. That's what window dressing is all about. When that big machines are buying chunks of stock, they don't sit around. Anyway, so this is a 4-hour chart, which is similar to closest thing you can get to a daily. I like this a lot. What it's telling me right now is we are going to find a major resistance around the 1950, 1960 level. So you're talking about 120, 150 points on the market, which matches what I was talking about earlier. And at that point, don't get too jiggy. If we fail at this lines, we're going to drop very quickly back towards the, in my opinion, if we fail here, we are going to come back to retest this broken. You know, this was a bear flag. It broke out of the bear flag. Okay, that's a good thing. So we might very well come down and test the 1920 level again. Very easily we can test that, or we test the 1900 level, which is really a psychological line in the sand. Okay. Where did the VIX close at? I didn't even see it because I wasn't here late on Friday. Anyone know where the VIX closed at? Let me look on my Thinkorswim. VIX closed at 20. Wow. That's good. VIX is trading between 20 and 30, ladies and gentlemen. So we could slip and slide a little bit, and on a real bull run, VIX might slip to 15, screaming short. VIX 20 is a screaming short in the market overall, depending on, you know, of course, the momentum is going to be higher because foreign markets are going to open higher after Friday's rally on our side, right? Or they might take profits because they had a rally already. Whichever the case, you're going to hit this level around 1950, 1960, manage your trades. That's it. It's as simple as that. Pattern symmetry dictates, if you just look at patterns, that if this is going to play out like this, then the most we're going to get to is the 200 around the, we're going to get to about 2000. 2000 S&P. So we closed at 1940, 2000. That's 60 points multiplied by 6 or 7 points. You're talking about 400 plus points, right? 400 plus points on the Dow. And then got a short. Short doesn't mean it's going to come down here. Short can simply mean it comes down, test 1950 again, move from here. Remember, the higher we move away from the depths of 1800, the more difficult it's going to be for the machines to pull us down towards 1800. Do you guys understand what I just said? Anytime you move away from the lows, you need a much larger drop to get down there. So it doesn't happen that quickly. That's all I'm getting at. But it doesn't mean it's not going to happen like this. So what I'm getting at is you're going to get towards about 2000. If you get 2000, I think 1950 should cap it. 1950, 1960. I want it to cap it. I want to buy the 1800 lows again, to be honest with you. And if we do this and we come down to 1800, we will have a or let's say 1860. I think that's really going to be 1800. I think that's this low. We're talking about 1860. Can everyone see that?
Yes.
Okay, so I'm going to show this again. Massive. We get a quadruple bottom. Quadruple bottoms, given this chart pattern, should have a high probability of holding. So if we get up here and we pull a pull back here, and that'll happen for any reason, we know that, right? Then that is a screaming buy, unless we completely puncture through it, in which case 1800 comes into play again. But generally speaking, looking at this chart pattern, watch this. Okay? That's like one of those cartoon figures I can't figure out. I just looked at it. Can anyone tell me what the hell it looks like? It looks like Pac-Man stuff.
Crown.
Right. Huh?
A crown.
A what?
King's crown.
King's crown. Okay, yeah. Looks like a king crab too, right? With two little eyes. But seriously, I mean, this pattern is very valid. Now, we break this, that's a different story. Then we're looking, we're looking far lower. So that's your picture on what's going to happen over the next week. And if this momentum continues, we're going to hit 1950. It's going to engage the 50-day moving average. No question about it. It will do it, one with the other. So make money off that. Now, looking at Thinkorswim, let me try to detach the chart from there. Bear with me. Thinkorswim, this is more visual, right? Like people can see it. They're like, oh, those are cute little pictures, this and that. But, oh, come on, man. Hold on. Bear with me. I think I got it. Yes, I do. Okay, let's look at this baby, okay? This to me is good stuff. Angular, geometric. Makes more sense to me. All right, you guys ready?
Yeah.
Okay, good. Let's hit it, okay? Thinkorswim. Thinkorswim is telling me right off the bat, and this is how way I'm reading it, so take it for what it's worth. Look at what we did. In a matter of from the week of the 20th till the 29th, that's 2 weeks, right? Yeah, 2 weeks. We are totally overbought. We went from the lows that I was screaming about when everybody was like, not everybody, but a lot of people are like, oh, this market's going lower. This is it, this guy, oh, forget it. I mean, I'm sick and tired of hearing it. I mean, I'm sick and tired of people getting all frothy at market tops, and I'm really sick and tired of hearing people saying, oh, this market's finished, right when it's like totally buyable. But you know what? I'm actually not sick and tired. I just laugh. Because I've seen that same stupidity happen so many times, it's not even funny. I'm telling you straight trader talk here, okay? So bottom line is, at this point, we are severely overbought. Now, couple of things will happen. And let me just get straight to it. Get the lovely drawing tool and show you fine folks what I think is going to happen. This, ladies and gentlemen, is still a bear flag. Now remember, this is a key point. Depending on what chart you're looking at what time frame, the market is going to send you different signals. So this is still a bear flag. It's a bear channel. And if you remember what a bear flag is, or is basically where you have massive short covering, people get all excited, then we get to the top of the bear flag, which happens to be, look at this downtrend line that I drew and touched a whole bunch of points, 1950. That's on the E-minis. So once you get towards these levels and we engage the 34 and possibly engage the 50 moving average, that's at 2000 plus on the S&P, 1999 on the cash E-minis, you are going to you're going to hit. So what I'm getting at is these are danger points. Now, somebody says, well, things are getting better. Okay, so let's say things are getting better. Let's not try to overanalyze what's happening in the world because none of us really fully understand. Let's face facts, okay? If I can't fully understand it, trust me, most people out there are completely clueless. I mean, really clueless, okay? So saying all that, this is what happened back on September 29th. We went from being down here, right, at these junctures, which are screaming buys, repeat, screaming buys, and at least holding certain things and staying on the long side, to getting overbought here, minor pullback. Look at that red candle, minor pullback on the first week in October. It just created a small thing here and stayed overbought in between minor pullbacks. You can see that here, and continue to climb higher all the way from September of 2014 all the way to October, first week in November 2nd of 2014. In order for that type of scenario to happen, the markets need to remain overbought in a big way. So what I'll be watching, and you guys can too on your think or swim, charts, whatever, is where the level of this retracement is going to be on the daily. In other words, if it stays overbought, don't be a frigging hero. That means the market wants to rip the heads out of the shorts and can continue to move forward. Here we moved from 1820 to 2090. Somebody might say, well, that's not going to happen. I don't think it's going to happen. But it did happen, and it can still happen. Never say never, okay? But I think that's too optimistic. My point is that I think we get towards a maximum move. We get towards 2000 S&P, 1999 E-minis, and we do a nice little pullback. Let's see what happens. I explained to you about the moving average and stuff. So on the stochastics, what you have to watch is the reaction of the STOs at these levels. So that's the bullish scenario, that they stay overbought and the market continues to climb. Is that clear with everyone?
Yes, it is.
Let me give you the bearish scenario, which I actually like better, just so you know that, because that's the big money. Remember, as markets keep on climbing higher, it gets more difficult to make money. I'm telling you that right now, because you just don't know at what point this thing is just going to collapse. So I can't overload myself, and Savvy and some of these people know that. Fish Eyes, I think he left. He knows that too. Is I start to reduce my positions as we move higher. I do not like 30-point gap opens every day. And people who know me, they know me. I love 30 points gap downs where either I have some index shorts and I have cash on the side and I can lump in and play these things for 30, 40 points, as I've been doing. So saying all that, runaway trains like this, I don't like. But who cares what I like? So let's give you the bearish thing. We got a massive pullback and we get into overbought territory like we did here, right here. Okay, everyone see that clearly? And then you get a complete collapse. I highly doubt that we're going to get another 2,000 point plus collapse immediately after a 2,000 point collapse. Does everyone understand my superior English here? I highly doubt we're going to get another 2,000 point plus collapse after we had such a recent one. In other words, the markets want to reverse, call it reversion to mean, repair, whatever the case, a slight calm before the big storm, whatever you want to call it. However, once we get towards in this zone, past 1950, we have to be tactically short. And we can be tactically short even intraday, you know, on the stuff. For this to happen, for the market to go up another 400-500 points, we need to stay overbought for a whole bunch of days. February, generally, statistically speaking, after a ugly January overall, February might turn out to be a little bright spot for the bulls. Okay, just remember that. And that's statistical. You get after a multi-week drawdown in the market, you get a couple of weeks and the market basically breathes a sigh of relief. And that is very much a possibility. But I do want to warn people that we are overbought on the daily, and that one must keep an eye on that when they're managing their trades on the other side, on the stocks that we trade. Fair enough? Now, let's take a look at the weekly to see what the heck's going on. On the weekly, the candles are telling me we still want to go up past, we want to go back and test the mid Bollinger. Same story as the daily. Looking at the stochastics in the weekly, either it turns up, which would be very bullish, or it turns down, which means we're going to retest the lows of 1860 and possibly lower. So that's not, I watch like simultaneous charts, so, just letting you guys know. Now, another thing on the daily that I particularly don't like from the standpoint of getting too gung-ho is the McClellan oscillator, which I talked about extensively at the lows, minus 300, you buy hands down. This is the point of maximum aggression. You've heard me say this. Point of maximum aggression. And this is the point of maximum despair. And this is the point that everybody comes and tells me the market's going down. And I quietly keep on buying. I don't know, that quiet, I tell people to buy. And most of them don't listen to me, which is fine. Stay poor. So, bottom line is that this one can either go get maximum overbought at 300, which is max overbought. That's when I start to scale into my shorts in a nice swing position, puts, and I keep on scaling. Every little move up over that in the market, I keep on buying more puts. Just the way I keep on buying more calls, scaling in, as I like to call it, from these bottoms. So at this point, we are at an intermediate top. There is no question about it, purely by looking at the charts. It does not mean that we can vacillate a little bit here and make a move up towards 300, get everyone super excited, slam the market down 600 points. So just letting you guys know. These two lines, it's all you got to follow. Now, these type of candles, which I watch very carefully too, especially on the E-minis, are capitulation candles. This is when they all gave up. Of course, we know that the market's run by oil, so we have to watch that in order to determine that. But generally speaking, these are flush outs. These are the point where nobody's in the room, nobody wants to say anything. They're all shit scared, and the few who do say something, they're telling me that the market's going down another 500 points. Behavioral game theory at its best. Same old story every single time. So these are the points of maximum pain. These are the points of maximum aggression on the long side. Same thing here. Let me pull down the chart. You can see that clearly. All right. Now, so that's it. So there's the bear channel. We need to break out. If somebody wants a confirmation, which nowadays are very rare, you know, so a technical confirmation would be a breakout on the E-minis over 1960, and a real confirmation would be a breakout over 1990 or so on the futures, because at that point the market will go and test 2070, no question asked. That's just the way it goes. If you want to look at it on the S&P side, you are going to see, whoa, see the difference? There's a straight line up. That was the bear flag getting decimated Friday. So at this point, there's heavy momentum on the upside. However, machines will easily destroy that momentum. What I look at as my trained eye is I look at the supply point out here. It was looking like the markets wanted to bounce off here too. So there is a supply point out here where there will be sellers, institutional sellers. Everyone clear on that? So if that happens, it's possible that we come down. You know, remember there's an uptrend line here, uptrend support. We come down back towards 1900 and then possibly make another move. Also, you can call this a left shoulder. You can call this a right shoulder, which is 1900. And then if we make a move, then we're going to start kissing 1975 and 2000. That's the 50-day. That's the 34-day. In the meantime, I'll be watching a lot of stuff. In the meantime, if you look at it this way, the bearish view would be that we are severely overbought and we could very easily do a sharp pullback. Sharp pullback doesn't mean the end of the world. I'll certainly be there to make money on that. And it simply means that we are going to come and test. We're going to give back like roughly about 100 to 150 points. If we give back below this line here, which is 1890 on the E-minis, you can very easily stay short all the way down to 1820 again, which is the which is basically the Bollinger. If we break this level, it'll be like a cascade, you know, stops triggered and things moving and things falling and stuff. But by that time, we'll be down here at 0 again or close to it on the stows. So that's really, you know, what's going on out there. Now, saying all that, let's take a quick look at oil, which I've been playing through DWTI. I am really getting good at it. I don't like saying that about myself. Okay, but I'm getting good at this. I don't think I've made 70 points on something that fast, that quick in a while. All right, honestly, I could just trade DWTI every day and just take home some real loot. What do I need? If I told you I could give you a stock that moves $1 a second, and if you're on the right side, you can make 20 points in 20 minutes, you'd be like, yeah, well, this is it. But it's a dangerous one, right? Depends on oil. So anyway, this is the daily. Just want to give you guys a little thing. And by the way, this has made significant amounts of money. And you don't even have to play that much. You don't need to buy 1,000 shares. If you do that, you're nuts, because within seconds you're going to be down $6,000, $8,000. So do it at your own speed, whatever you want to do. Now this is starting to look pretty damn good to me. I don't think oil's a runaway train. Okay. I'll show you oil and I'll show this and we'll cap the evening. What time is it? 9:50? What time did we start? 7:30? Okay, we're fine. So look at this. This is big, guys. Okay, this is really big. I just saw this for the first time, actually. 1 second. Daily. Okay. Can everyone see this clearly? Can everyone see this clearly?
Yeah.
Yes.
Okay. So time to wake up. I want to make some serious money. I don't care if you buy 1 share, or if you buy 10 shares, or you buy 100 shares. But if you don't trade the DWTI, at least with just a token amount, you don't know what the heck you're missing as a trader. If you think that you can buy one share of DWTI at 244 bucks, and I don't care whether you make 10 bucks or 60 bucks or 100 bucks, it's a mental thing, then feel free to leave the room right now. I'm dead serious. Just the way I tell people you need to buy one share of these ER plays. You think I'm demeaning anyone? No. I'm simply saying you got to be engaged in battle to learn how to fight. And it amazes me that a lot of people still don't do it because everybody is waiting for some perfect thing here. This is exciting to me, guys, okay? I just saw it right now, and it's exciting. I sound like Trump here. Keep on repeating the same thing. So let me repeat it again. This is really exciting, okay? All right. Look at this. 7.36. Give it to me. This thing's turning up. This is the daily. This is the daily, okay? Anytime you get to these levels, I sound like a broken record, but who cares? It is going to turn. It doesn't mean it's not going to vacillate down here a little bit. At this point, the DWTI, the beast that Savvy's hooked onto and doing well, congratulations, and Sienna, is now resting at its 50-day moving average, right there, at 224.21. Below that is the below that is the 200 line. This gray line is the 200 line at 196. If we break the 196, we automatically gravitate towards the lower Bollinger. That's clear. And by that time, this baby is going to be down here. Like, remember, it still can't go below zero, right? So at one point, it gets so oversold, it just kind of just stays there. So this falling wedge is exciting. To my trained eye as a chartist, this is exciting. And there are two hollow candles. Ladies and gentlemen, you got two hollow candles and a falling wedge. That's as good as winning the lottery. Technical lottery. Not to say that it might not work. This is basically telling me that at this point, this falling wedge is going to break to the upside. We already played this range. 270, 224. We already played that. The entry was 227 and change and 228 and change on Friday. You all know that. Went to 270, right? No, went to 265. Give me another stock that moves 45 points in one day like that without a takeover. So what I'm getting at is this little movement, even if it moves back and forth between here, and I'm going to start initiating shorts on DWTI too. So you better get some real like straight jackets here. So this is the trading band, 40 points here. Okay. If it breaks out of the trading band, sayonara. You are going to hit 302 so fast, you will never believe you saw it happen. It's true. Now, what I find interesting is that even after this massive fall from 484 and myself like an idiot missed this whole round, really, I didn't feel good. That was my worst thing I ever did by not being in it. And I promised myself it'll never happen again. So bottom line is that even after this massive fall, can somebody tell me what didn't change?
No cross up.
The what lines?
34.50.
Yes. Exactly. It didn't even budge. As if nothing happened. Great answer, Savvy. And I hope everyone's clear on that. Look at these two. This is the highway, like I like to explain in simplistic terms because I'm a simplistic kind of guy. The moving averages are the highways that prices travel in. You deviate from it too much, you shall come and meet the road again. Right? Who sang that song? Was it the Eagles? My wife was watching the Eagles show last night on CNN. She loves the Eagles. So here we are. The moving averages, as Savvy pointed out very clearly, didn't even budge. This baby's not scared of oil running away anywhere soon. Okay? Because it's a machine. This thing is a real algo. I'm serious. This is not this is a derivative algo and it doesn't care. But beware, it does move violently. So just be prepared for it. Play with 60 shares, 100 shares. You get 20 points on it, and all of a sudden you're like, whoa, shit, I didn't make $2,000. I haven't made $2,000 in a day in like whenever. Like some people will say that. Like, oh my God, you can do it on this type of thing. Put a stop. 6, 7 points. Like, okay, I'm going to lose $800 versus making 3,000. That's risk reward. You got to figure it out yourself. I'm not going to tell you how to do that. So lower end of the wedge, by the way, just so you know, if it slips below the below this 50 line, this one is here, and that is 209. This is a very defined chart, by the way. So I'm showing you real money here. So the defined chart is you're looking at 209 here, and it's got a hollow candle which is glowing as I'm moving over it. And you also have a hollow candle reversal, which normally should break down this way, just so you know. Should go down this way. Didn't happen. Can it happen? Yeah, the Saudis can come out and say, that's it. We're cutting 500,000 barrels a day or 50,000 barrels a day. Those bozos can move the market up big time. It'll fall real hard. So beware of that. However, on a daily basis, they looked like they were all buyers despite oil moving up. They were all buyers on Friday. See that? So you have to also watch the volume, because this is clean volume. DWTI is not trading in the dark pools, all right? So whatever you see is what you get. It's all transparent. So anyway, this one, if it really breaks out, you're going to see 300 real fast. Very fast. Optimal buy point would be nice to be in the 190s, obviously. Now remember, that's 44 points below here. So, watch it. Now let's take a look quickly at but this is the internals are certainly appealing. No question about it. Now DWTI being an inverse, I noticed there's something about the VIX too. Look at what's happening on the McClellan oscillator. Normally when the McClellan oscillator is up here, we say it's deeply overbought, correct? Overextended, correct?
Correct.
Yeah.
Yes. In an inverse ETF, simple math, it's the opposite, because it's an inverse. When it's all the way up here, like seriously overvalued, the McClellan oscillator is going to be seriously undervalued because it's the inverse. You get it? So you'll have to flip it out. So in other words, here at 185 for an individual stock, we'd say very overbought, got to be careful, all that good stuff. In this particular case, that's a pullback from 484 to 244. That's 200 points or 240 points. Because it's a flip over, the McClellan oscillator is at 187. You get it?
Yes.
There you go.
Yeah, pretty easy.
It's pretty easy. It's an inverse. A lot of people don't get it because when I first saw it, I didn't get it. I'm like, no, not with DWTI, with the VIX, because the VIX does the same thing. All right, UVXY and actually VIX does the same thing. So this is a bullish pattern. If you showed me a stock like that, I said, that's it. I'm buying calls. Not to mention that it can fall 44 points in 3 minutes. So let's take a look at the hourly. And this is one thing I noticed on my iPhone when I was out of the DMV. Is the hourly also is kind of moving sideways. It didn't budge. The iPhone charts are pretty damn good, When I look at, I normally use investing.com to look at their charts, and they're pretty damn good. I just use the candles. You can actually not just trade off them. I mean, I could actually chart off them. So let me do this. in real time. There you go. So right now, you could wake up in the morning up 8 points because the upper end of the wedge is, make it bigger, and let me make it white. That's better. There you go. A breakout over 252, not that it acts like a stock, but I'm just showing you. Easy 270. Just the way I showed you guys on Friday. All right? So you got to play it and stack it. Now, on the lower end of the wedge, this is a very clean chart, is, one second. How you draw these lines can make or break you, just so you know that. So I join, oh, this is perfect. Join 1 point here. Okay, so 1 point here. But this was the low was actually here, 210. The 1 point here, but I'll take this. So 212 would be a fantastic buying opportunity. If oil moves up, then that's what's going to happen. In the meantime, this is a falling wedge. What do falling wedges do? They break up. Up meaning they break higher. Let's see. Let's take a look at oil. What's going on? I've been pretty good with oil, so I'll show this to you guys and we'll wrap the evening. In the case of oil, this is your daily. Oops. This thing took a mind of its own. Hold on. So here's your daily of the oil. With oil, I look at the candles and I look at the Darvas box and it's done well for me. Very simple. Oil right now is obviously trending higher. Any break over 34.80, I did say 34.90 or 35 was going to be the tops, and I was right for Friday. If this breaks out over 35, next point of engagement is 36, possibly 38, which is the upper end of the Bollinger. I think that's the max move on oil. Oil is basically going to be stuck between 30 and 40 bucks for the next months and months and months to come. Unless there is a major supply disruption or the Saudis finally panic and cut production in a big way, in which case you're looking at, you're looking at 50 up here. But one step at a time. This is the thing I read as a chartist. All right, so let me get these lines out and you guys can just do what you need to do, but just giving you some helpful pointers here. Oh, come on, man. What does this look like? Forget these lines. Look at the Darvas box here. Right? Look at this Darvas box. Are these narrow or wide?
Pinched.
Very pinched. That means a big move is coming. My opinion, lower. Look at the stochastics. Severely overbought on a daily. I think oil is going to come. Yes, Jeremy, we'll do it right now. Oil's coming down. If oil comes under 32, you get 30 points on the DWTI. Every penny is $1 in your pocket. Literally. Okay? That's what I'm saying. Play one share, for God's sakes. Just do it. It's not going to kill you. So this is overbought. I think oil's going to pull back a bit. No Armageddon, just pull back a bit. Everything is overbought in oil right now. McLaren oscillator, stochastics on the daily, all kinds of stuff. So this bottleneck, or it trades within this band, whichever the case may be. So what I do is I've shown this a zillion times. I basically just, if you think of swim, you just put DWTI next to oil. I put the 15-minute chart out there, or the 5-minute if I really want to keep a close eye on it. And I do it like this. And every little zig and zag is money in my pocket. There you go. So you just have to put the different charts, set up the different studies, And this was Friday. I bought it down here, right down here as I saw it turning. Okay. And this is what happened. Between 10 o'clock and I guided people, to 11:30, it went up frigging 40 points. And I keep
Is
on.
the
What?
Sorry to interrupt. Is the pattern not looking familiar to Dragon Bullish?
Don't
15-minute chart?
let me just tell you one thing. Let me warn you something, Shawnee, okay? And write this down and paste it. Don't pull patterns on overall patterns on DWTI. It'll smash patterns like nobody's business. The reason is, I repeat, it is a powerful, maniacal derivative of oil. Oil has certain patterns on a wide basis. On an intraday basis, oil doesn't give a crap about falling wedges and all that type of stuff. So yes, I understand what you're saying in good faith, but that's very naive. What I'm looking at simply is the fact that there is a gap fill here. Okay, there is a gap fill here, 220. There is another gap, by the way, well, minor gap, somewhere around 206. But on an interim basis, on this type of thing, you can call this a falling wedge and this and that, but do not try to transplant patterns on short-term movements on DWTI. Therein lies my thesis. Play with a few amount of shares, make the money, and feel like a champ.
Thank you.
Yep, because they move so fast. I mean, forget it. What I did notice, which I posted beautifully on my Twitter chart, was let me just put it out, is this. One second. I think this was classic. And anybody who... Look, that's a pattern. See that? I put this out before it even got there. If any, Savio obviously remembers, he was playing it in Sienna. I saw this reversal candle on oil while some of the newer members were in there just saying, oh, oil's going higher. Yeah, right, oil's going higher. I mean, there was massive selling right there off the bat. It was overbought. And I said, let me just keep on adding. Let me just keep on adding. And that is a perfect Dragon Bullish encapsulated by 265. And it just went to 265, correct? I did put a gap fill out there just in case it went up there. Because if it blew out over 270, it'll go to 290 so fast you wouldn't even know. But I was watching oil on the other screen. And that oil kept on telling me that it was finding a base around 32.73. So if you're going to play this, you got to play this exclusively, because every little candle is worth 10 points or 20 points. And it's not hard. And you know why it's not hard? Just don't play with too much money. You know what's hard? When you have too much money in something and it doesn't go your way. That's hard. So let me just wrap up this thing here, because I'm giving you the facts of the realities of how trading and investing works. So look at oil right now. You can see this on a 15-minute. It's bottomed. It's looking like it's bouncing. Look at that. It could very well be at 34.20. So it all depends on what time frames you're looking at. All right. Wanted to look at Google, and that was Jeremy. Yes, I put out the Google chart, so I'm going to go over that again.
Excuse me, I do have to run, but I would like to say I appreciate your teaching lessons, and
No.
it's nothing but quality.
No problem, Johnny. Listen, Johnny, it was good having you back. Hope everything's all right, and we'll see you. Okay. But stay engaged, and like I said, with the DWTIs and stuff, which are new things, just do it with few shares and see how good it feels, or how bad it feels. What was that?
I do.
Okay.
I truly do appreciate your direct approach. Thank you. Good night.
No problem. Take care. Sean is in she's in the North Pole, by the way, guys. Seriously, you know that?
No.
Yeah, she's in the friggin' North Pole. She lives in what's the town? Anchorage is Alaska. She's in she's in North Pole. I mean, it's unbelievable. And really cool. One sent me pictures of the North Pole. I'm like, that's great, man. So some big town she's in. I forget. Okay, so Google, no way of telling. Okay, Jeremy. Bottom line is, this is the hourly Google. So from a technical standpoint, it's very overbought. Google doesn't give a crap about that. Best case scenario, we are going to basically rip out $800. I believe the implied vol on Google is, let me just look at it on my other side, is 48 points. So 48 from here takes us to exactly what I said, right? 48 plus 760 is what? 808? 808, okay, 808. So there you go, 800. That's the 47 points is implied move on Google. Just looked it up on TOS. You guys can do it too. You know, put it up there. It gives you the market maker, you know, plus minus. They're pretty accurate. So Google either does this, which looks likely, because remember, Google is more comparable to Facebook than Apple, correct? Or Amazon.
Correct.
And if you guys wanted to know why I shorted Amazon, it's because I freaking shorted Amazon because the stock was severely overbought. It given what was supposed to happen after hours, the smart money took intra hours. So that's it. That's really the way to look at it. Why would a stock be up 60 bucks or 40 bucks or 50 bucks before earnings when you should give it after earnings? But the algos and the fast money knew. Suck in the idiots. Slap it in. Because you don't want a stock to move 60 points before earnings. It's really as simple as that. Just remember that. If Google moves 60 points before earnings, I'm sorry. I will short it. Small amounts, but I'll short it. Here's my points. Google has a gap. This is a gap. Okay, so it'll go into the gap. So we got 20 points in Google before earnings, which would be fine. Google could go to 800. So you know. Because technicals get blasted out of the water when earnings come out. Now, on its way to 800, it could do this, just so you know. It could fall to about 7, it could come and engage 745, 740 for seconds, literally after hours, because no one knows how to read their numbers. No one, trust me. None of you guys do, trust me. Okay? There's a lot of different metrics in Google, and this time they're going to break out the different divisions, alphabet and all that stuff. So it's going to be a much harder read. So please don't try to be analysts on Google, okay? Please don't try to be an analyst on any earnings, just so you know. All right, and coming from a guy who reads numbers better than most people. So just watch the price action. So 740 would be could be the immediate pullback, and then it moves. So I'm going to play common on Google and buy a couple of calls. Which ones, I don't know yet. I still think this is the left shoulder, right shoulder, engagement at 740, like a quick drop, right? 20 bucks. If it stays stagnant here, obviously it's not going to do that. And then it heads towards 800. Once it hits there, Google could be the, you know, remember, a lot of money came out of Apple, a lot of money came out of Amazon, right? So they got to find a home somewhere within that sector. So they're going into Facebook, they're going to Google. So that's, you know, that's just the way it is. And by the way, you guys, I sold those Priceline lottos, I think around $4 or something. Was anyone playing that? I didn't even know till I was looking at my iPhone. I'm like, holy cow, I got a bunch of these, which I just left there for dead. You did, right? It was fantastic. It was like, boom, you know, between CMG and those lottos, that was the day. Forget DWTI. Yeah, so I just like punched out and I had a bunch of them and I'm like, okay. And I let it go and they took it so fast. And it was pretty cool. But anyway, so we'll look at that for a second. So that's my choice in Google. If Google breaks down and they do some stupid stuff, which I don't think they'll do because they have that lady, what's her name again? The one who came from JP Morgan? Their CFO, I forget her name. It's just, you know, drawing a blank. She's fantastic. She's managing Google's finances like a nanny changes diapers, okay? So she's doing a fantastic job. What's her name? I don't know. She's a big name, and she's handled very well. Because Google's biggest mistake was they would talk big, do great numbers, and then say, "Oh, we're spending $1 billion, you know, doing this," and boom, the stock would fall. So I think she's managing the fiscal part of it very well, and that's a very big plus. So anyway, so I think this is the trajectory. This is what Google's going to do. If it breaks below 730, then Google will fall to 700 fast. So that's your downside, which I think is more lower probability in my opinion. So Jeremy, so that's the answer to that. Now, let me give you a quick look. We're going to start wrapping up here. Let me give you a quick look at Priceline. Guys, believe it or not, Priceline has the highest upside right now. All right, based on my methodology of looking at things which are distressed property. At this point in time, Priceline just doesn't need to even resume a frigging uptrend. It just needs to bounce, just the way it did on Friday. Okay, so what does a bounce mean for Priceline? A bounce for Priceline means these things are so steep you can't even draw the lines. They're like 90-degree bungee jumping stuff. Or what do you call that? What's that thing called? You know, the human what's that sport called? It's like hang gliding, except they're jumping off cliffs. You know, what's it called? You know, and paragliding, right?
Yeah.
Yeah, the guy died, like the main guy, right? The guy was watching show on him, and just like, so this is paragliding, buddy. Okay, so so all you got to do is do this. I don't care. Resuming an uptrend means Google has to go over 220 and change its whole behavior. I don't care. I mean, sorry, Priceline. All I care at this point, because it's so frigging cheap, $1,000. Okay, you could trade it just on a minor bounce. You could get 100 points right here, just to test the falling wedge, which it was trying to enter or getting close to it before it failed again. Unless something is really broken in Priceline and they've become a terrible company and they're based in Amsterdam, so everybody is, you know, completely bombed out on their local hash. Okay, I highly doubt it. Priceline's management is one of the finest in the world, and I think that they will deliver numbers which are going to be slightly better than expected. If that is the case, ladies and gentlemen, you will get 100 points on Priceline from here very easily. And God help us if they split the stock. If they do split the stock will go to 1240 so fast, you'll be like, whoa. You know, everyone's going to be like, wow, they're split, you know. Priceline is, remember one thing. Can anyone tell me another tech stock that is still $1,000, meaning like non-split? Another big name tech stock? I can't think of any. Can you? Can you guys?
Not at all.
Exactly. End of story. What if Priceline splits the stock? That's it. So just a minor bounce. Minor bounce will take you to 1100. And a major bounce will take you to 1200. So you got 140 points on a major bounce, and on a minor bounce you're looking at 1100. Is it possible that it revisits 1100? I mean, sorry, 1000 before it does that? Absolutely, absolutely. So that's my take on Priceline, but they don't report numbers till down the road. Let me just show you one more. Okay, I showed Google. Let me show. I'm gonna wrap this up now. Amazon. Where's Amazon? There's Amazon. Amazon actually looks pretty damn good, to be honest with you. Don't forget, these companies never fall out of favor. Amazon, you know, guys who are really dogmatic, they're like, oh, they're finished, you know, they'll never come back. Like, shut up. Nobody's ever worked. I mean, most traders, almost no traders have really worked within the complex of real money management, right? Fund managers. They don't give up on something unless they do something really stupid. So they're not giving up on Amazon. They just want it cheaper, that's all. And plus they ran it out. Up. Amazon fell here. This is exactly where it was on the 22nd. What's the big deal? Think about it for a minute. This is exactly where Amazon was on the 22nd. That's exactly where it fell after hours. And on top of that, that's a hollow candle. So Amazon, in my opinion, will most probably go to 600 before it pauses. And do not be surprised, and I've seen this happen way too many times, that this pattern gets repeated. That's it. You know, So Amazon is done. If it falls, I honestly expected Amazon to test 545. It can do that, but given the large scale buying that happened on Friday, my last the first set of short worked fantastic, and then I bought a little bit more because I covered after hours and this and that. The second bid that I bought didn't work out. I got stopped out, like 20-point loss. But what's that against 70 plus? So so that's what I'm saying. This thing is creating this, and Amazon could very well hit 600 real fast. It can do it in 2 minutes. All right, last one is CMG, and then we're gonna wrap it up. Do I have it here? This worked out nice. Oh, I gotta show this. This is American Airlines. This is a fantastic chart. This stock is going to go to 42 and then to 44. You know what the calls to? They'll be like 300-400%. That's how those calls move, and they're cheap. I kept on buying it because when it fell earlier in the day, and then it went positive. Look at this. These candles. At this point, you're looking at about 41. This is a good trading stock which doesn't kill you. Just so you know that. Okay, American Airlines. So I like this chart a lot. CMG, do I have it here? Yeah, of course. Okay, here we go. CMG, this is it's got a lot of tails, okay? That means there are sellers in there. Look at the reversal. We did so well on those, 15, 16 points, blah, blah, blah. Sold it, and it just didn't do anything. So best way to look at it is weekly. On the weekly chart, it has to stay above. It has to stay. It's still a green, it's still a green doji, so that's okay. It's still moving higher, so I'm not going to go negative on this. I would say that once we cross over 480, you're going to see a fast move to the upper mid channel of 517. At that point, you're going to hit a lot of resistance. It will be overbought on the day, weekly by that point, I believe, and we'll see from there. Again, just like the market, same old story here. Definitely a negative crossover, 50 and 34. Standard deviation from the 50 and 34 is way too big, way too much. Can CMG recover? Absolutely. They've already told, they've already guided the street down. So CMG is actually bullish from for a tactical standpoint. You can get, in my opinion, 50 points on this stock. And God help us that if it hits up and kisses the thing, you're looking at $600. Certainly a stock to keep in mind. Given everything that we're seeing here, you're starting to see short covering going on. I like it. It's good. So ladies and gentlemen, we shall wrap up for the evening. And let me just see one other thing. Any quick questions that I can answer? Because we covered quite a bit of stuff tonight. Any questions? No? Okay. So I'm going to put this up. TW, good, man. We shall, there's a lot of earnings coming up. Always have a bunch of cash on the side. Don't take any large position in this type of market. It doesn't matter, how right I might be or what forecasting I do. Trust me, this market is maniacal, okay? So just be careful. But in the meantime, let's go do what we do. See you guys tomorrow morning.
Thanks, Blue.
Anytime. Savvy, talk to you later. Bye-bye. Take care.